Hello, everybody. This is John Hernandez, and I'm a CPA and enrolled agent, and I've been in financial services for 10 years. And today I want to share with you tax benefits that are available to self-employed and business owners. But more specifically, these are tax benefits that aren't those headlines, flashy, gimmicky, maybe tax strategies that you've heard about on TikTok or other social media. No, this is not your cost segregation, bonus depreciation, and who knows what else. These are the tax benefits that are really accessible to self-employed and business owners, aren't really too complicated or too costly to implement, and you can potentially start, working on these today. So let's jump right in. So, accurate bookkeeping. You might have heard of bookkeeping. Maybe you're trying to do the bookkeeping yourself in QuickBooks or in Xero or on a spreadsheet. But fundamentally, in my years of practice, I've been in financial services for 10 years. Bookkeeping is one of the biggest ways to get your tax situation, one, in compliance, right? And two, you'd be surprised how many tax savings we found through accurate bookkeeping, meaning bookkeeping that is accounting for what's going in, what's going out of the business accurately, the way the IRS wants it, right? Meaning that you have substantiation for transactions like receipts, you have, bills, invoices, etc. And again, with that, it allows you to maximize write-offs. Like, how many times have I seen a business owner that at tax time comes and it's like, we start asking questions, we look at their books, and then they're like, oh, and I also spent $10,000 in supplies, but that's not in the book. So had we not asked, you would have missed out on that deduction, right? That's a common example. With the IRS, a problem that I see with not having good bookkeeping is that it can trigger audits if it's just, wrong. Like maybe you're just throwing numbers on a spreadsheet or just guessing, it can trigger an audit. Or two, if you are audited and you don't have proper books, you don't have, like I mentioned, the substantiation, the records, the IRS is going to say, hey, prove us that you spent, $50,000 in gas or whatever it was. You don't have it. Well, you're in trouble, right? They can disallow that. But fortunately with bookkeeping, because I realize business owners are so busy, you can obviously hire an accountant, a firm. Like my firm personally does full service bookkeeping from start to finish, monthly reporting, profit and loss, everything. Or you can, try to do it yourself if your business is small enough or you don't have much going on, you don't have too many transactions. But bottom line, there are digital solutions available, right? There's apps, QuickBooks, Xero, there's HubDoc, there's many apps to capture receipts, etc., right? And then just a quick pro tip with receipts, records, you want to have, that supporting documentation at least 3 to 6 years, in case of an audit. And again, for reference point. The next one is tax entity selection. So choosing the right tax entity, not legal entity, tax entity, that's what I'm talking about here, is more than just branding, is more than just, let me pick a right name, right? It's more than just the name. And looking at this here for business owners, you're either sole proprietorship. This is the default if you have a business. Maybe you open a LLC that's just in your name, or maybe you're just doing business as a DBA, as a fictitious, as a trade name. If it's just you, the default, the IRS is going to treat you as a sole proprietorship. Very simple, and everything gets reported on your 1040. Downside with this is depending on how much profit you have, you may start getting hit. Well, in general, you're going to be hit with self-employment tax, right? Which is an additional tax on top of your income tax. Now, there's other things like QBI deduction, things that can factor, but if your profit gets to a certain level, that self-employment tax definitely can start making a much bigger impact, definitely can hurt a lot more, and that's when we talk about other things. That could potentially lead us to an S corporation conversation. And let me just reiterate, on social media you may hear everybody needs to be an S corporation, but that's definitely not true. Like if you're just starting out your business, you're not making any profit, you don't have much going on, 9 times out of 10, S Corp isn't going to be right for you, at least at that moment. Maybe down the road, maybe once you're profitable, but there's many factors that come into play. Now, the S Corporation, generally speaking, does have some tax benefits because you can get, savings on payroll tax. You can save that self-employment tax, right, on the distributive share. However, S corporations are rigid. They're strict. They're inflexible, and they have other red tape and formalities that get imposed on business owners. Sometimes they don't even know, and that could be a cost. You have to pay, really ideally, an accountant, a CPA, an enrolled agent to get that all squared away for you. We do it for our clients, but I'm always honest to say, hey, this is going to cost X amount, and if you're only saving less than that in taxes, doesn't make sense, right? So we're going to do that analysis. We help our clients with tax entity selection, but you as a business owner should be mindful of the fact that there are different entity types and they are treated differently. It affects how income is taxed, how deductions are treated, how they apply. C corporation, you've probably heard there's double taxation. Not really common for small business owners, to be honest. Usually C corps, you see, the Walmarts, you see those, huge corporations. They have some tax treatment benefits, obviously, like a fringe benefits, and you can raise capital, and there's other elements to them. I don't want to talk too much about them in this, because like I said, generally speaking, most micro small businesses really are in C corps. And then partnership, which a partnership could apply, same with an S corporation, could apply if you're a multi-member LLC. So if you have an LLC and you add your cousin, your neighbor, your whoever to be a business partner with you, now you could put, by default, you're going to be a partnership, right? And partnerships, they're passed through just like S corporations, but they're much more flexible. On the flip side, though, they pay self-employment tax generally on the earnings. There's also other things, guaranteed payments, and it can get more technical very quickly, but they're much more flexible in terms of allocation and other things, property, contributions, distributions. So again, multi-member LLC can apply to S corporation or partnership, technically even corporation. But right now we're mainly talking about the main three: sole prop, S corp, and partnership. They have pros and cons to each. So I'm not sitting here telling you which one you need to be. It's just more for you to know that there are different ones. They have pros and cons, and it's situational. Consult with a professional. Do your research. But depending on the size of your business, this is definitely a good time to loop in a CPA or an enrolled agent. Like I said, this is something we do with our clients so that we can consult and advise and actually crunch the numbers. All right. So big potential here, because you don't want to be in the wrong entity, and then now you're paying so much more in taxes, or maybe you're just paying so much more in accounting fees that you're actually losing money. So again, it's important to optimize the tax entity. Okay, now we're going to move on to timing of income and expenses. And what we're talking about here is really deferral and acceleration. What does this even mean? So basically, to give you an example, I think this is the best way to think about this. And this is something that I haven't really seen on social media or TikTok, but it's very important. One thing that we do with our clients, generally at the end of the year, we do a tax planning analysis, right? And we usually do a meeting where we kind of discuss what's going on with the business and plan, right? We have a few months left of the year. What can we do to make sure you have the best taxable outcome legally, right? So one of those things is income, right? So let's think about, maybe there's a big contract coming in, right? You're working with a prospect, and you know that this deal is going to close. You're going to, earn the revenue. You're going to deliver the service or product or whatever. It's just a matter, but you have flexibility. So it's a matter of timing. Maybe you can say, hey, we can do everything in December and collect $1 million from that. Or we can do everything in January or February of next year and collect that $1 million. Well, then that poses a question. Does it make sense to accelerate, so do that income in December, or does it make sense to defer it, right, when possible, and put it in January, February, or beyond? Well, the question of that, there's no right answer, without knowing the situation, is going to be based on what's your tax liability next year. If you have a higher tax liability next year, then maybe it makes sense to put that income in this year when your liability is lower, right? Because that affects tax brackets, et cetera, AGI, et cetera. Same with expenses, right? If you have, you're going to buy a large amount of supplies, you can choose, here you have more control. You can choose to pay that in December or again in January of next year. And this is where we consider that, right? Like if you have a higher tax liability this year, then maybe it makes more sense to put those expenses in this year to lower it, right? So there's many factors, but this can be a huge game changer. And with this, it can get a little bit more technical on the accounting side. Obviously you need good books, because if you don't have good books, how can we know what your situation is? How can we plan for next year? So first, you need good bookkeeping, going back to what I mentioned earlier. But then two, understanding cash versus accrual, right? Because this is when we get a little bit more specific, more into the weeds, and I don't want to jump too deep into this, but that also affects this part of it, right? This is really when you want to work with a CPA, somebody that understands accounting and can help you actually understand what makes sense and run those numbers for you. So for example, with cash, generally that's when, you're recognizing income and expenses when they're, like paid out or received. Accrual is really when it's earned. So not necessarily when cash has been paid or received. So I know that's kind of just a really abstract definition, but that does affect timing, right? Because then we have to understand, are you cash, are you accrual? And there's also other nuance laws within the tax code that can impact this. So again, work with a professional, but at least be mindful of those things, that at least like, hey, if there's a big expense coming up or a big windfall, big, job coming up, understand that timing matters and it's important. So this is a big one. Again, I think it's very underrated, but it can make literally thousands of dollars in difference. So just to wrap up, the 3 elements that I mentioned, and again, nothing flashy here. This is the core. This is the foundation. This is what every business needs to have before they start moving into more complex things like cost segregation, bonus depreciation, and just the other complex depreciation strategies and other elections. First, let's set up accurate bookkeeping, right? Making sure that you understand what's going in and out of your business month to month, ideally, if not at least quarterly, semi-annually, or annually. Make sure everything is tracked, categorized correctly, right? Next is making sure you have the right tax entity. Ideally, when you set up the business, you want to work with a professional and know like what you're getting into. But if not, if you already have a successful business and you realize, hey, this business is making money, maybe you're paying too much taxes, then this is the time to pull in a professional and actually run the numbers. Actually, get the insights. What's the right tax entity for your business, for your lifestyle, that is gonna give you the best tax outcome legally, right? Again, we do that. We do a questionnaire, we run numbers, we make projections, and we recommend the right tax entity for business owners to help them get the maximum tax benefit. Finally, strategic timing. That's of income and expenses. We talked about deferral and accrual. Very important, impacts tax liability, but requires a lot of planning, right? This is something that it's not you just do, you plan. So really the action step I would say is do your research, partner with a tax professional, make sure you have digital tools implemented, and you're being mindful of these things, right? Even if right now it isn't the moment for you to, make a change in your entity or anything like that, but definitely start thinking about it. Keep it top of mind. If you have questions, reach out to me. I'll make sure my contact information is in the description. Subscribe for more because I really want to start creating more of these videos. I'm getting a lot more questions from clients and from social media. And we can definitely go from there. So thank you, and I hope this was helpful, and have a good one.